I just want to tell you right now to start this video, I make 2 videos a day here on this channel. If I make a third video that comes out like later in the evening time, like this one, it's an unscheduled video and it's something you need to hear as soon as possible. And that's what this video is. Oh my gosh, guys. I don't know how much more obvious it could be. The Fed was lying to us yesterday with FedEx's earnings report. And more specifically, what the CEO of FedEx just said, specifically about the Fed's rate cut. Like, not too often do you get CEOs that basically call out the Fed. And this is pretty unique. And I just have to say, kind of concerning. I mean, not kind of, but like very concerning. Okay, so the headline of this article says, FedEx quarterly profit disappoints as demand for speedy delivery wanes. This does come after FedEx reported earnings today in after hours. And as I talked about in the video earlier today, FedEx is a bellwether company for the economy, meaning that if FedEx does well, the economy is doing well. If FedEx does not do well, most of the time the economy is also not doing okay. And yeah, judging off of the 11% decline here in after hours for FedEx, which is probably going to get a lot worse before it's over, I would say FedEx is not doing okay. Okay, so this article says FedEx reported a steep quarterly profit drop and lowered its full-year revenue forecast on Thursday after its customers continued to trade down from speedy, pricier delivery to cheaper, slower options. Okay, so this is the first part that's really bad, but not the worst. CEO Raji said industrial demand was softer than expected. Shipments between manufacturers and other companies in that segment are the most profitable for FedEx, which is often seen as a bellwether for the US economy. Okay, let's break this down in a little bit more English, if you will. FedEx transports things from companies that make things to companies that sell things. Or let's say if you are a parts supplier for GM, for an example, and let's say you make tires or you make drivetrains or whatever it is. You make those products, FedEx ships them to GM to assemble them. And I'm just trying to simplify this, right? That is what the CEO of FedEx is referencing, that this demand was softer than expected. So less things being built or manufactured, less things being shipped. That is not good. But hold on, it gets worse. Raji says, quote, the magnitude of the Fed rate cuts yesterday signals the weakness of the current environment, referencing to the Federal Reserve's decision to cut interest rates by 0.5 percentage point on Wednesday. He said this on the conference call today. Basically, you guys seen Jerome Powell cut rates 0.5%. Like that's a jumbo rate cut. Things are clearly not good, is basically what the CEO of FedEx just said. Now, in this article from Barron's, it says the economy just isn't helping. And there is a troubling shift happening, which shows why the Fed just cut benchmark interest rates. Thursday evening, FedEx reported adjusted earnings per share of $3.60 from sales of $21.6 billion. Wall Street was looking for earnings per share of $4.75. That means you missed estimates by $1.15, about 25%, on sales of $21.9 billion. So they missed on top line revenue by $300 million. That's not as bad. That's almost 5%, but not terrible. Which, yes, it is terrible. It is bad, but it could have been worse from the standpoint of, oh, it's not terrible. I mean, EPS was down 25% lower than estimates. 5% for top line revenue, we'll take that. No, don't be confused. That's still really bad. It says, looking ahead, FedEx expects to earn between $20 and $21 a share in its fiscal year 2025. The range given in June was $20 to $22 per share. Now, it was a little bit more specific than that. On the low end range, FedEx guided for $17.90 or so, if my memory's correct, in the $17 range. On the higher side, FedEx guided for about $20.50 on the higher side. So yes, they are doing a bit of really rough rounding for the sake of this article, but still, FedEx lowered guidance. Even Wall Street got this one way wrong. Bank of America analyst Ken Hoekster was ready for some seasonal weakness, reminding investors that FedEx fiscal first quarter, which spans the summer months, is typically a slower quarter for the economy. Hoekster trimmed his earnings estimate ahead of the report to $4.76 a share from $5.21 a share, reflecting a slowing economy. He wasn't aggressive enough. FedEx also said that sales growth is expected to be a low single-digit percentage increase. So maybe 2%, maybe 3%. That's really not good. Now, I think this also, as a visual kind of puts us into a little bit of context as well. You can see in the latest numbers reported, the FedEx Express business was down 4% year over year, which is bad. Last quarter, you were down 2% year over year. So things are not getting better. They're actually getting worse. Okay. If you look at the FedEx Freight business, that was down 16.3% year over year. Last quarter, you were down 4.7% year over year. You down 16.3%? Are you kidding me? That is terrible. It says, and this is kind of more of, again, that visual chart. This is revenue from FedEx Express, which is their main part of their business, if you will, the FedEx trucks that you see. Yeah, and this does not look good either, right? This is definitely on a downside trajectory. Just looking at Q4 of 2022, which is, it comes here, Q1 2023. It was actually Q4 2022. You had revenue from the FedEx Express side of their business at $19.18 billion. The latest Q1, again, which is this latest quarter, was $18.3 billion. Yeah, that's really, really not good. Okay, you have seen some incredible weakness in the last couple of years, and this is the worst quarter in years for FedEx. Now, again, I don't scrutinize a lot of specific companies here on this channel all too often, but only important companies for the economy, like FedEx, like UPS, like Walmart, right? Dollar General, perhaps. Those are the companies that I really pay attention to that report earnings, especially last quarter, because we got to face the facts here. Whether it's because of the election, whether it's just because of an influx of immigration or bad practices in collecting data, for one reason or another, or for all of those reasons, the government data we get is not correct. It's not accurate. Jerome Powell literally said that on the podium yesterday, that perhaps if we knew the jobs were going to come in so low with a revision, we probably would have cut rates in July. Crap. Government screwed even the Fed. So the government, you know, the Fed, all of these guys have zero ramifications for, you know, lying to you. And to some degree, they're actually incentivized to lie to you, especially the Fed, and not tell you the full truth. I think we can all agree on that. So you can't really count on the government data, okay? But what you can count on is company earnings, because companies, they're not allowed to lie to you. It's strictly forbidden. You will go to prison if you lie to investors, okay? Much different than the Fed, much different than the government, or the BLS, if you will. If you don't want to just call it the government, just call it the agency, the Bureau of Labor Statistics, okay? We'll call them out specifically. So what do we have here? The best we got is earnings to judge the state of the economy and what companies say. And what I heard from FedEx this evening is what I would call outright scary, saying, basically, you've seen what the Fed did. That just highlights the problem in the economy right now. What? Let me tell you right now, I don't think the markets are going to react to this. I think markets are on a sugar high. I think the next couple of days or perhaps the next 3 to 4 weeks could be positive for markets until we price in election risk. And then after the election, we'll start to get more accurate data coming out from the government. And then maybe it'll start reflecting the actual decline in economic activity that we are seeing right now. But long story short, I'm not expecting markets are going to react to this. I think Tesla stock can do very well, and it will do very well. I think small caps will do very well. Cyclicals, value, dividends, right? Probably even big tech will likely do very well. Now, as we head into really the second half of October, after this, let's say 2, 3, 4 week period that we're going to have of bullishness ahead, in my opinion, that's when we're going to start running into big tech earnings, more important companies, and that's going to start potentially weighing on markets if these companies have bad things to say. You know, back in 2007, the Fed cut rates 50 basis points on September 18th. I've made that very clear for you. Literally the same day we cut rates again this year. But what actually happened back in July during the Q2 earnings results, Walmart issued basically a dire warning that the consumer was slowing down. And that's one of the reasons that prompted the Fed to start reducing rates. Now, back in 2007, 2008, there was a lot of phony data as well. Coincidentally, it was an election year, 2007, and there was a lot of revisions to data as well then. So the best kind of heads up you had on the economy was corporate America, because they have to be honest with you. They are audited and they will go to prison if they are not. Fortunately, I think this is another one of those scenarios. I think Wall Street should pay attention to FedEx. I think this should be a huge red flag, but is Wall Street really going to care too much? Probably not. Again, we're on a sugar high from the Fed cutting rates 50 basis points and telling us exactly what we wanted to hear, that the economy is great. We're just normalizing Fed policy. We're going to throw you a 50 basis point cut. In fact, there's a big problem, and FedEx just highlighted that. So again, nothing changes in the near term. If you want to trade this market to the upside, that makes some sense. I think Tesla's going to do very well. I think certain areas will do very well. But I do think you want to have a lot of cash on the sidelines, and you, by all means, want to be ready to go shopping when recession risk gets priced into our markets. Remember, like 2022, you don't actually have to see a recession to see a lot of downside. Long before we go into a recession, technically speaking, the government says we're in a recession, you're going to see a shit ton of downside for stocks. We've seen that in 2022. S&P fell 27%. We probably would have fallen more, maybe 35%, 30-ish%, if we actually went into a recession. But at the lows, you were down 27%. You were literally pricing in a 100% chance of a recession. Now, I think perhaps you'd need to fall at least 35% now to fully price in a recession, maybe more than that, depending on the severity. But eventually that day will come where the economy does get worse and we will be forced to price in a recession. And I do think Wall Street also wants to see how people react to this 50 basis point cut. And unfortunately, I don't think it's going to do much of anything. I think, one, the psychology has changed with especially younger people really from like maybe teenage years, right? 18, 19, 20 to 40-year-olds, where people got a lot of money with COVID. They spent a lot of money, ran through that money, and then the last couple of years they've been eaten alive by the price of living. I don't think people are going to rush out to go buy that new car, go buy that new house, go get that personal loan to do this and that, go on vacation just because the Fed cut rates 50 basis points. So I think we need to be a little tame in our expectations for what Fed policy is actually going to do to consumer spending behaviors. I just don't see it having that much of an impact. After all, the Fed cut rates and treasury yields actually rose. It became less affordable to buy new loans or get new loans, buy new things on credit than it was even 2 days ago. I think from that standpoint, the Fed could still be way behind the curve if, let's say, a 50 basis point cut is acting like a 25 basis point cut in actual real terms of boosting consumer consumption, consumer spending. If the consumer has changed, if the underlying, principle of the economy has changed, then the action from the Fed is probably not going to give you the same result as it did in prior cycles. So in fact, the Fed cutting rates, let's say a whole point, like 1%, may only be equivalent to like 50 basis points in real terms, which is something that I think time will tell us, but I'm like 90% sure that's the cause and effect of the Fed lowering rates right now. I just don't think it's as impactful as it was in previous cycles. So we will see. Again, I think markets are going higher in the near term. I think Tesla's stock, as I said in the last video, is likely going through a short squeeze now, and I think it's probably going to continue a whole hell of a lot higher in just my personal opinion. I don't think there's much to stop Tesla here over the next 3 weeks until the robotaxi event itself. After that, after the election, specifically for the broader markets, that's where we could find ourselves up Schitt's Creek. But I think you have some time here where markets are on a bit of a sugar high. So let me know what you guys think about this down below in the comment section. I would love your thoughts. Hit the like button, subscribe to the channel. You guys have a great rest of your day, and I will see you in the next one.